Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Emerson Electric Co. quarterly report. Emerson Electric Co., a technology and software company, provides various solutions across multiple regions worldwide. The company operates through 6 distinct segments: final control, measurement and analytical, discrete automation, safety and productivity, control systems and software, and test and measurement. The final control segment offers control valves, isolation valves, shutoff valves, pressure relief valves, and regulators under several brands, including Anderson Greenwood, Betty's, Crosby, Fisher, Keystone, KTM, and Vanessa. The measurement and analytical segment supplies intelligent instrumentation, measuring physical properties of liquids or gases under the Flexim, Micromotion, and Rosemount brands. The discrete automation segment includes solenoid valves, pneumatic valves, valve position indicators, pneumatic cylinders and actuators, air preparation equipment, pressure and temperature switches, electric linear motion solutions, programmable automation control systems and software, electrical distribution equipment, and materials joining solutions under the AFAG, Appleton, ASCO, Aventix, Branson, Movican, PAC Systems, Sola HD, TESCOM, and TopWorks brands. The safety and productivity segment delivers tools for professionals and homeowners that support infrastructure, promote safety, and enhance productivity under the Greenlee, Clock, ProTeam, and RIDGID brands. The control systems and software segment provides control systems and software that collect and analyze information from measurement devices in the plant under the DeltaV and Ovation brands. The test and measurement segment offers software-connected automated test and measurement systems. Overall, Emerson Electric Co. provides a wide range of businesses and services across various industries, including process and hybrid industries, discrete industries, infrastructure, safety, and productivity. Der Aktienkurs von Emerson Electric Co. EMR hat sich in den letzten 12 Monaten 133% erhöht. Dieser Anstieg ist auf mehrere Faktoren zurückzuführen. Eins der Hauptgrund für die positive Entwicklung des Aktienkurses ist das stark Finanzergebnis von Emerson Electric im Geschäftsjahr 2025. Das Unternehmen meldet ein Umsatzwachstum von 3%, einen Anstieg des operativen Cashflows 11% und des Free Cashflows 12%. Der Gewinn pro Aktie EPS stieg 43%. Emerson prognostiziert für das Geschäftsjahr 2026 ein Umsatzwachstum von 55% und ein Berinnungs EPS zwischen 635 und 655 US$. Ein weiterer wichtiger Faktor ist der Upgrade des Ratings von UBS auf Kaufen mit einem neuen Kursziel von 168 US$. Der Analyst von UBS begründet dies damit, dass temporäre Herausforderungen im Softwaregeschäft des Unternehmens ein stärker Zugrund liegen nachfrage Verdikten und ein beschleunigtes Gewinnwachstum erwartet wird. Schließlich hat Emerson auch new Finanzial für 2028 vorgestellt, darunter einen Nettumsatz von 21 Milliarden US$, 5% organisches CAGR, ein Berinnungs Segment-EBITDA-Marge von 30% und ein Berinnungs EPS von 800 US$. Das Unternehmen kündigt außerdem an, bis 2028 10 Milliarden US$ an Aktionäre durch Aktienrückkauf und erhöht Dividenden zurückzuführen. Insgesamt haben dies positiven Entwicklungen zu einer Erhöhung des Aktienkurses von Emerson Electric Co. geführt. Emerson Electric Co. market capitalization of $86 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Emerson Electric Co. holds a significant advantage in their industry. Emerson Electric Co. trades at a higher price-to-earnings ratio of 37 times and a lower price-to-book ratio of 4.22 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the data provided. On the growth side, the Intelligent Devices segment has been a standout performer, with a significant increase of 173% in 2024 compared to the previous year. The Software and Systems segment also experienced strong growth, with a 38% increase in revenue. The Safety and Productivity segment saw a more modest but still notable increase of 45%. Within this segment, specific product lines such as test and measurement and final control have shown strength, particularly in regions like Europe and the Americas. The underlying sales trend has also been positive, driven by higher prices and favorable foreign currency translation. On the decline side, the Corporate and Other segment has seen a significant decrease of 22.3% in revenue. This is largely due to a downturn in Asia, Middle East and Africa, particularly in China, where revenue decreased by 8%. The flat performance in this region is also attributed to a 5% decline in China. Overall, while there are pockets of growth, the decline in certain segments and regions highlights areas that require attention for future improvement. The net income of the company experienced an increase from $593 million in 2024 to $606 million in 2025, resulting in a growth of $13 million. This upward trend is also reflected in another set of data, where net income rose from $585 million in 2024 to $605 million in 2025. However, despite the improvement in net income, profit margins did not show significant progress. The gross margin decreased from 53.5% in 2024 to 53.2% in 2025, indicating a slight decline. Additionally, SG&A as a percent of sales also saw a decrease, dropping from 29.3% in 2024 to 28.6% in 2025. These results suggest that while the company's net income is increasing, its profit margins are not improving at the same rate. The company's financial performance indicates a strong ability to generate operating cash flow. The data provided shows that the company has consistently produced positive operating cash flow in recent periods. Specifically, as of September 30, 2025 and December 31, 2025, the company reported operating cash flows of $1,544 and $1,748 respectively. Additionally, the operating cash flow for December 31, 2025 was a notable $699 million. These figures demonstrate that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. The company's debt level has undergone significant changes over the past year. While long-term debt has increased by $744,000 from $7,575 to $8,319, short-term borrowings have seen a notable decrease of $2.485 million in net value. This mixed trend suggests that the company is taking on more long-term obligations, but reducing its reliance on short-term financing. In terms of interest expenses, there has been a substantial increase from $8 million in 2024 to $90 million in 2025, representing a staggering rise of $82 million, or 1,000%. This significant jump indicates that the company is now shouldering much higher costs associated with servicing its debt. The sharp escalation in interest expenses suggests that the company's financial situation has become more challenging, and it may need to reassess its borrowing strategies to mitigate these increased costs. The recent market analysis reveals a mixed performance across various segments and regions. In terms of segments, control systems and software, test and measurement, sensors, final control, and safety and productivity stood out as the top performers. These segments demonstrated strong growth and stability. On the other hand, no segments were reported to have performed poorly. This suggests that all segments maintained a steady pace, with some showing more promise than others. Looking at regional performance, the US, Europe, and Americas emerged as the strongest markets. The US and European regions showed consistent growth, while the Americas region also demonstrated a positive trend. In contrast, Asia, Middle East and Africa, and China struggled due to China's underperformance. This had a ripple effect on the entire region, leading to a decline in overall performance. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. According to the financial records, the company paid out $303 million in dividends in 2024. This indicates that the company values its shareholders and is committed to returning value to them. In addition to paying dividends, the company has also been actively buying back shares from the market. In 2024, it spent a significant amount of $946 million on share buybacks. This move not only boosts shareholder value, but also reduces the number of outstanding shares, thereby increasing earnings per share for existing shareholders. Concerns about inventory buildup emerge. Recent data suggests that there may be issues with inventory buildup, a potential sign of supply chain disruption. The numbers are telling. Total inventories have increased by 140 units, while finished products and raw materials/work in process have seen significant jumps of 43 and 97 units respectively. This trend is cause for concern as it can indicate a mismatch between demand and supply, leading to inefficiencies in the production process. If left unchecked, inventory buildup can result in wasted resources, increased costs, and decreased competitiveness. That concludes the financial summary for Emerson Electric Co. Feel free to comment below, and I will be happy to answer them when possible.